Hello everyone. Chapter 2, Analyzing and Recording Transactions. In my opinion, this is maybe one of the most important chapters for you to really study and get a handle on, because chapter is not going to go away. It's fundamental to everything you do. So definitely spend the time to get to know this material. It's not going to go away. It's just going to get added on to. So let's get into it. The accounting process. It's a four-step process. Number one is you have to analyze each transaction. And what I mean by analyze, you get your source documents, you analyze what accounts you're going to be affecting. And then once you've identified that, you then record the event in your journal and then your general ledger accounts. And then from that, you can prepare your trial balance. So let's look at this process. First, what are source documents? Accounting likes to get its information from as much third party because that adds to the verification and accuracy. And those third party documents can be like checks, bills from your suppliers, purchase orders, bank statements, sales receipts. Again, it adds to the validity that a third party has verified this kind of financial information. An account is a record, or where you keep a record of all the increases and decreases, and this account will be for every specific asset, liability, equity, revenue, or expense account. Now the general ledger is what I call, for maybe help you think of it as maybe the first book of entry. It's a record containing all the used by the accounts here. So, and what it is you have all these, like for instance the asset accounts. You will have cash accounts, accounts receivable. Let's take accounts receivable as an example. You'll have sub-accounts within that, and that sub-accounts will be virtually from every customer that you do business with, that you extend credit to. Inventory would be a listing. You'd have a T account for every item in there, for every kind of inventory item that you carry. Same with the liability accounts. So you're going to have sub-accounts and sub-accounts as you go through these. But through all of these sub-accounts, it will be one of these three things: an asset account, a liability, or an equity account. So the basic accounting equation is fundamental to understand, and also fundamental to the identification for your recording process. Let's take the asset accounts. This is just a starting list. It's not all inclusive, but we have some basic accounts starting with cash, and this will go in the order of liquidity, cash being the most liquid. Accounts receivable is your customers who owe you from purchasing or using a service that you provided. Notes receivable is a formal loan. It's a note that you've signed in a formal legal document. Prepaid accounts is like deposit accounts. Maybe you have to set up for your utility bill, maybe a deposit of $100 or so against future bills and so forth. Supplies is things you're going to be using in the utilization of your business. This is different than inventory. Inventory is raw materials you use to either build your product or resell to customers. So don't confuse or understand the difference between inventory and supplies. I think equipment, buildings, and land is self-explanatory. I understand there can also be more asset accounts. For instance, there could be intangibles. You have with tangible and intangible. Tangible is something physical, something real you can feel or touch. Intangible is like a legal right. An example would be copyrights, patents, trademarks. These can have significant value and are assets, and we'll get into those later in the weeks to come. Different kind of liability accounts, accounts payable. This is what you owe your service providers or your vendors for work or materials that they sent you. Again, notes payable is like a notes receivable. It's a formalized loan agreement, formalized in a writing instrument. Unearned revenue is an area should be flagged, because a lot of beginning students have trouble with this account. They see it as revenue and they mark it as a revenue item in the income statement. It is not. This is where someone is prepaying you for work or for a product to be delivered at a later point in time. And so what it is, it's actually an obligation, i.e. a liability. You've received the money, but you haven't delivered the product or service yet. Once you deliver that product or service, it would then become a revenue. But unearned revenue, the name can trick you, is actually a liability. And accrued liabilities, accrued means over time. And these are liabilities that grow over time. In the classic case would be interest. As a loan goes over time, every month you're going to accrue like an interest expense. And then your equity accounts, you got owner's capital. This is what owner's capital is also known as owner's contribution. This is money that the owner has put into the business, maybe to start the business. Owner's withdrawals, again, he's withdrawing his money. And then you have revenue expenses, which is actually from the income statement. That changes the equity component of the balance sheet. Here is an example of the expanded accounting equation. Again, you have your assets, liability, and equity accounts. This is your basic accounting equation. And then we expand the equity component to show the owner's with capital contributions, the owner's withdrawals, any revenue minus any expenses from the income statement is all a component of the equity account. A ledger and the chart of accounts. A ledger is where you keep track of every individual account. For instance, in cash, you might have a variety of cash accounts, i.e. you might have multiple checking accounts, you might have multiple cash registers. Take accounts receivable. You will have a ledger account for virtually every customer of yours that you sell on credit. Again, you'll have a ledger account for each kind of supply you use, or prepaid, or equipment, and it goes on and on throughout the variety of accounts. Now the chart of accounts is a listing of all your accounts, and this chart of accounts will grow or diminish as the business either grows or declines. And it's constantly in flux, and the CFO will add more chart of accounts as you get more customers or more vendors or more employees and so forth. This slide is important to understand. This is the basis of your ledger account. And this is known as the T account. There's three components. Actually, I think there's four, but the book only describes three at this point in time. And the first point is first the account title, i.e. the name of this account. For beginning students, this could actually be a challenge because there can be a lot of names. But again, there'll always be a basic asset, liability, or equity account. But you can have different types of assets, different kinds of liabilities, and every account will have a title. For instance, accounts receivable / Jim Forbes if I'm a customer of yours. And then you have this T, hence the term T account. This T divides this account into two parts. And that two parts is the left side and the right side, known as the debit and credit. Many beginning accounting students assume that debit and credit means increase or decrease or plus or minus. It does not. It means simply the left side of the column or the right side of the column. Depending on what type of account you are doing a transaction, a debit could either increase or decrease. It will vary depending on the type of account. Now the fourth component in the T account that's not listed in the books but is very common is usually between the account title or the account name will be an account number. And this is because computer software uses the numbers versus the name. So a lot of times an account title will also have a number associated with it. Double entry accounting. This is what we're starting with the basic accounting equation. Now you drop down below, and now you have the expanded equation, or what you're really having is showing is all the debit or credit and when to debit or credit an account. You'll notice, like for assets, if you're increasing an asset account, you will always debit it. If you're going to decrease it, you will credit it. Yet it's the opposite for liabilities. You debit if you're decreasing and credit if you're increasing both the liabilities and the equity account. Another term that you need to get comfortable with, because you will be on the test and you'll see it, is called the normal. What's the normal balance for an account? Let's take the most simplest account, cash. Cash is an asset. Well, cash, you'll either have no cash or you will have a debit balance. Because think about it, cash in your pocket. You're either going to have cash or no cash, but can you have less than zero cash in your pocket? No. So you would really never carry an ongoing credit balance in cash. You will carry it as a debit balance or no balance at all. And so where you normally carry that balance is known as the normal side. And you'll see that'll be different for the liability and equity. You carry the normal balance on the credit side. There'll be enough for this first part. I'll start part 2 in a separate video. Thank you.